All right, guys. Thank you all for joining. Still have a few people trickling in. But thank you, Anne, for allowing me to do this. I've been talking to a few people in the group through DM and, sharing some videos about how I personally trade. And this conversation ended up getting started, and I figured, you know what, it'd be awesome to break down a few trades that I took today and how I look at the markets from an OB perspective, institutional perspective, as well as potentially how you guys can use these alerts that Ann sends out to get a really high win rate, in my opinion. All of the stuff I'm going to be talking about today, guys, is what I do. You guys can, take what you like. Discard the things maybe you disagree with. Everyone sees the market slightly different. But this is kind of just breaking down how I go about my trades on a daily basis. And hopefully, it will help some people find some clarity in their own trading journey. So what I will ask for people to do for now is obviously, let's all stay muted. If you have questions, feel free to post them in the chat. I will try and get to them. At some point, I'll probably, reference a question and let that person, either if they want to talk or if they just want me to answer it, that's fine. But it allows me to kind of go through my concept more efficiently, and then everyone can basically then contribute afterwards if there is confusion or questions. I will try not to go too fast. However, I don't have unlimited amount of time today. So if things are going a little quicker than you understand, save it maybe for a question at the end, or just rewatch this video because Anne's going to be recording it. So you'll be able to replay this as much as you want. All right. So first things first, I'm going to go into, what I look for from a higher time perspective, and then how I go about breaking that down to find what I do, which is sniping entries off the 1 minute, because I like to take parts of the market in and out, get out of my trades, within 20, 30 minutes. I don't like being in trades for longer. I know that other people, that might not suit their personality or their own trading style, and that's fine. Everything I'm about to explain to you guys is kind of what Anne's been talking about, and it will happen on the higher time frames as well, because the market is fractal. So as you see things on the lower time frames, they are also playing out on the higher time frames, just slower. Okay, so let's just go to Euro USD. So this was a trade I took this morning. And I'm just going to break this down from a 1 hour perspective. And again, we'll go into the daily. We can go into like what I typically do every Sunday, guys, is I'll go in for myself and I'll look at the weekly. I want to see what the week did so that I can understand potentially what that week might bring for that pair. I'm just going to clear off some of these things so that we can see it. So in this case here, this was a trade I took not off an OB, but off what the market did last night inside of the London and New York session, because this market movement is, and I have these fair value gap regions listed out, guys, from my weekly analysis. And fair value gaps, I'll get into a bit of what that is. But I have these zones listed out, and this is why I believe that Euro USD is bearish. I believe that price is going to start filling in these orders that were left behind. But the trade I took today was a counter trend to that based on what the London session did. So when I'm looking for, so let's just get into like an OB strategy perspective. So when I'm looking at the higher time frames, weekly, daily, it doesn't matter. I find a zone that I'm interested in. So let's just quickly find like an order block zone that you might like. So let's just go here. I'm going to delete this annotation. Let's delete all this stuff so you guys don't have to see it. And let's say that, I can go through the definition of an OB. I think everyone understands. Are people having issues? Someone says, Kyle, are you sharing your screen? I am sharing my screen. Is everyone seeing this? Is everyone hearing me? Can you like type a message in the chat if you're hearing me? People are hearing fine? Okay, cool. All right, so I'm just going to give a quick definition of how I look at what an OB is from a definition perspective. In my opinion, an order block is, the last down or up candle before an impulse that broke structure. Very simple definition. So if we were looking at stuff like this, admitting a few more people, in this instance here, you would go and you would say, okay, this zone here is your order block zone that created like an impulse low, right? Now, I look at this as a break of structure. However, it's a continuation break of structure, right? Because we're in a bearish market, we're in a downtrend. Other people are looking for reversals. So there would have been like order block here on the lower time frames because this would have broken this structure. However, if we're talking about continuation trades, this would be like a new impulse low, so a lower low. So this would be the last order block that created that impulse to the downside. So you might then want to say to yourself, okay, I'm going to wait for price to come up into this zone. Now, if you're just simply taking an order block at face value, this would have probably stopped you out. Like if you're saying, okay, I'm going to take a daily order block and I'm just going to, sell at the top and I'm going to put my stop loss at the bottom and I'm going to ride this to, 1 to 5. Well, you lost that trade. And this is where I start to break down order blocks slightly differently because I don't want to wait. This move here. Let's say you didn't get stopped out. I mean, that move was 18 days. I personally don't want to be in a trade for 18 days to net 1 to 5 when I know that I can go to a lower time frame, get 1 to 5 on, in an hour or in 5 minutes or whatever. That's the way I look at the market. And so let's just kind of break down this from a simple point of view. So, and again, guys, everything I'm about to explain, you literally can apply to any time frame you are on. You just have to remember that at the lower time frames you go, you have to remember what the higher time frame bias was. And this is where sometimes people get lost in the 1 minute, 5 minute, 15 minute, because the 15 minute is not making the overall directional move, right? The higher time frames are telling the market where it wants to go. So even though you might win a trade from a bullish perspective, the overall downtrend might be bearish, which means you just have to adjust your expectation for your win, your RR, right? And I can talk all about that a bit later. But that's just remembering where you are in the market as you scale into your trades. So let's just take this trade, for example, because it's kind of a good example of where like you would have lost this if you just took this for face value on an order block. I'm going to turn off some of these indicators because I don't need them right now. I'll explain them later. I like to then go into this zone. So I'm hoping TradingView will let me go into that zone because it's a few days ago, but let's keep going in. So let's say you might want to scale into this on an 8 hour and you might want to refine it because maybe the 8 hour makes more sense. So in this case here, I could then say, okay, I want to refine this order block to, more of this zone, right? Because this makes more sense from now the 8 hour impulse and then come back into it. Again, if you took that trade, you would have been stopped out. And this is why I like to scale in. I like to keep scaling in. Or you can wait for a market structure to form again on, guys, the higher time frames. And we'll talk about that. So let's maybe just take that as a quick example. And then I'll start going down into the 1 minute, etc. So we scaled in now on that daily order block to the 4 hour. Okay. So if we're going to apply the stuff I'm about to talk to, how I trade from the 1 minute perspective into the 4 hour, you would then refine this order block to this area, right? Because this is the last impulse. Oops, sorry. This is the last impulse. Now, some people might say, okay, they want to refine it more because this actually was the last up candle before the bearish structure broke here. I'm just going to delete this alert. But if you're talking about like how you scaled into the trade, this is just a manipulation zone, in my opinion. You could have still caught a trade on the 1 minute down here, but there's liquidity above here, and we'll talk a bit about that. And this is how I draw up my charts. So I basically refine, and I have these templates that talk about liquidity meaning where orders and where the banks are probably going to want to fulfill those orders so that the price can actually keep going down, right? Because if you guys think about how like retail mindset trades, they're putting their stop losses above this, thinking that, price is not going to break it. And obviously then, they get stopped out. So this is how I start drawing up my charts. I put my break of structures. I put my liquidity zones and I start to wait for trades to come to me. So if we look at the 4 hour, if you would just enter this 4 hour candle on an OB, right? Well, again, you would have lost that trade, even though it was a successful trade, because you didn't wait for price then to tell you what it wanted to do. Like price can do anything it wants. It doesn't have to stop at this order block. It can just keep going higher and higher and higher. So what you can start to use is a confluence, and that's what I like to call it, like a confluence of the overall direction. And is the order block going to be respected? Is you start to wait for price to tell you the story, and I shared this in some of my videos with the group, tell you the story of that it's actually going to be respected. And so what I mean by that is you can see here, you have a new impulse high. It made a higher high. You had a 2 candle pullback. Okay. Now I'll talk a bit about this. I know there's been some questions asked in the group based on that I use 2 candle pullbacks versus 1 candle pullbacks. 1 candle pullback meaning like this candle pullback here, 1 candle pullback. It did not make a higher high from this impulse. It actually made a lower low here in this microstructure, and then it proceeded to go up. This leg of structure, if you were to scale this into the 8 hour, is actually just a single candle pullback, which is a rally-based rally. Rally-based rally meaning price basically went up 1 candle and continued on. This is a zone that you can actually use later as a potential buy opportunity. And as you can see here, when the price came down, it created a buy opportunity on the lower time frames, even though the price was still bearish. You can use these, and we can talk about that. I don't have time to cover all of that today. We can definitely do more videos in the future, but these are ways on the leg of the impulse to the upside. You can use these as trade opportunities on the downside. And so we have a leg of structure here that created a new impulse. We had a 2 candle pullback, and we had a new higher high. So let's just like draw this out here. So we had a higher high. Now, all of a sudden, what we see here is we see price start to retrace, right? And what happened? It ended up breaking, past this previous low point, right? So we now then would just simply be, again, guys, we're being patient, right? The longer you're patient, the more money you'll make. And that's, trust me, when I was learning how to trade this way, it was frustrating because I'm like, oh, I'm in a order block. This is going to be awesome. I'm going to make money. And then you'd get stopped out and you're like, well, that sucked. So instead, if we're patient, we can start to let price tell us what it wants to do. So in this case here, we have a BOS, right? Well, the BOS was created by this candlestick here. Okay, so if you would have waited for 50%, like Ann talks about, of this candlestick, right, it's pretty much around there, maybe actually perfectly at that wick. So in how I trade the 1 minute, I would have then entered here, right, and my stop loss would have been the swing high. And now, even though you would have lost this trade if you took it right on the order block, you actually are now in a very nice trade that, if you go down to the previous leg of structure here, is a 1-to-5 risk to reward ratio trade. And if you keep watching the legs of structure, guys, if the price is still bearish, right, if you start to see different trend lines and the price is still bearish, you can keep taking these trades as additional confluence while letting the first trade, the last 20% of that trade, if you like to take partials, for instance, you can let those trades run. Because if you look here, as I mentioned, this leg of structure here on the 8 hour time frame would have been a bearish bullish bearish pattern, right? And you can see that here, right? It's a rally-based rally, right? So it created a single candle pullback that made a new impulse high. This is a zone of interest that you can start to take your trades lower, right? So if we go back down to the 4 hour, you can see that price came into this zone. It created a new leg that broke structure. Well, this would have been another really nice order block trade, right? So if you put your order block trade, now again, I don't like to always, I would have scaled into this trade, but I would recommend personally, like if you're taking a 4 hour trade, you would put your stop slightly below, above the actual wick here, because this order block, the impulse was here. And and I can talk about this. This is called a fair value gap. There's orders here that have to be mitigated before price slows down. And again, these are things you're going to have to learn as you start trading. And I can talk a bit about that, but that is a more complex conversation and will take definitely more than one video. And again, though, if we keep riding the train down, right? So you have another, again, guys, remember when I talk about these pullbacks and these impulse highs, these are zones of interest that if you are interested in taking buys off of, they actually give you really good buy opportunities on the lower time frame. However, the overall market structure is bearish, right? So again, you have another 4-hour order block that got created that created a new swing low. Well, you can still stack on your trades. And remember, guys, your trades at the moment here are still running, right? If you trust the market structure is bearish, you already have this trade running, you have this trade running, and now you have this trade running. So, I mean, this trade at this point, if you would have held this trade from here, the 50% level of this order block, and again, guys, as Ann talked about, I firmly believe that if you're not scaling into your trade, putting your trades at the 50% actually gives you a much better RR. As you can see here, every single one of these touched into the 50%. And if you're still holding these trades, guys, like look at these 2 trades running. That's 6-1, and this is a 1-10 trade. So all we have to do, as you guys are seeing these order blocks alert from Ann, is wait and be patient for the market to start breaking this structure, right? And you'll find that your win rates will be exponentially higher, right? And we can start to then actually scale in, scale in on these individual orders. And if we quickly want to touch base on here on fair value gaps, you start to look at where the price actually needs to fill, okay? And this is where then you can start to snipe entries. So let's say we just keep taking these trades and we look at like this leg of structure here, because I probably would have been in a trade here because we're inside of the order block zone on the lower time frame. So let's, for instance, go to the 5-minute, because I know Ann says she doesn't go lower than 5 minutes. So let's just quickly take a peek at what the 5-minute will give us. And like I said, guys, the markets are fractal. Oh, it's way over here. And I do want to kind of break down the trade today that I did take so people understand exactly what I saw in the market for a real trade that I did take. It's going to be way back here. And these are other trades that I had taken. So let's go. These are the zones that we created here. Okay. So this is the zone. I believe this is the zone. Let me just quickly confirm that, guys, because I don't want to mess this up if it's not the zone. I'm going to make this black. Sorry, bear with me. 2 seconds. I'm trying to find my zone. Why can't I find it? Holy cow. Sorry, guys. I have a black box on it. It's got to be up here. There. No. Okay, that's why. It's way up here. We went like, I think a month back in price. Here we go. Perfect. Okay. So again, remember, I like to scale into my trades. So we are inside of a 4-hour order block, right? That's the red zone. And again, guys, remember here, there's a couple trades like Ann talks about, you know, you might lose a trade or two. That's fine. Like, that's the whole point of, you know, making sure your risk management is on point. So for instance, being as that I'm in the middle, almost done passing a funded account, I only risk 1% of my max daily drawdown. I don't risk 1% of my account. So however you guys decide to manage your funds, I think that's very, very critical. 1%, if you're scaling into the 5-minute, is a lot of money because you might have, like Ann talks about, 2 or 3 losses, and that's 2 or 3% down in your account. So personally, if you're going to scale into your trades, I'd be risking like 0.25. So, you know, 25% of 1%. In order to scale in, because then if you lose 4 trades, you're actually only down 1%. And the next trade that you happen to maybe win, you know what? You end up making back all those losses. It's just a better way to protect yourself. So for instance here, let's just break this down. So as we start to come into these trades, you might have yourself some trading opportunities. So this would have been my first trading opportunity for myself, right? You can see that market structure is holding these zones, right? So we have more than a 2-candle pullback. We don't have an impulse high, but we have a candle that touched this OB here, and then it keeps going higher. So this is a respected trade. We are not looking for break of structure there. It has not broken structure. You then have an order block here that broke to a new high. It was retested. That is now being respected. So we keep waiting for price to tell us something. And again, price is still making block flow is what I like to call it. So here's your first potential trade opportunity. You have a 2-candle pullback. You have a break of structure. And if you decided to get into this one, obviously this one might have lost. However, there's a couple people in the waiting room. This one I probably wouldn't have taken because this order block to me is not really that big of an impulse with the change. The wicks are telling you that price is starting to roll over. I would have taken probably one of these order blocks. So as you can see here, again, guys, we're talking about hindsight. So take what you want, but this is just basically how I look at the market. So I start drawing out my order blocks, you guys, from here. You had a 2-candle pullback, 2-candle pullback. It broke structure. So there's your first break of structure. You end up making a new swing high, and then you had an impulse leg to the downside. You did not have a 2-candle pullback in here. So if you were to scale this into the, pretty sure if you were to scale this into the 3-minute or 2-minute, this is a, or sorry, the 10-minute, this is one impulse leg to the downside. I don't want to change my time frame because it's going to make me find this price again. But this is an impulse leg that broke structure again, right? And all I'm trying to do, guys, here is hopefully help you see the markets clearer, right? So that you're not randomly taking trades. You're waiting for price to tell you the story that you can take a trade opportunity. So here's what I do. Now, in this situation, this is exactly how I would have taken this trade. I would have seen this impulse leg. I would have put a sell limit here. Okay, I would have put my stop out slightly above that high, and I would have waited for price to come into it, right? Now, depending on what the spread is or depending on how this triggered, if this triggers me into the trade, right, you have a couple other order blocks, but if, let's say, it doesn't trigger you into the trade, fine, that's not a big deal. If it does trigger me into this trade, I am looking for 1 to 5. Typically, 1 to 4 is what I aim for, but 1 to 5 is good. But you have to remember, I manage my trade a lot. Because I'm on the 1 minute, when this starts to make a 1 to 1.5.5, so around here, okay, guys, when price is around this zone right here, let me draw this out for you guys. When price comes into this zone, it's now at about a 1 to 1.5. And guys, I know there are people asking how to use the fib for your take profit zones on TradingView. I posted a video. I have mine set to the fib wedge. And so I can just simply do this, and click the button. You don't even have to slide it out. You can literally just click it. And now you have your risk to reward ratio. Okay. So it's beside you here, and you can change those to whatever color you want by just, double clicking on that and editing it and changing the colors. Okay. So once the trade is at a 1.5 risk to reward ratio trade, which is slightly higher here, I have to edit my wedge settings because it's off. I didn't put the 0 in there. Is that what I do is I move my stop now to break even. The reason I do this is that I put my stop to break even plus covering the commission of the trade, because if price were to because again, guys, you're on the 1 minute, so you're not always going to get like a 1 to 20. That's just not the case. If price decides that it doesn't want to actually break this lower low and reverse on me, well, then guess what? I didn't lose any money, and I'm okay with that. I'd rather break even than just keep taking losses. And so there's been lots of times that, price actually might even stop me out and break even and continue lower. I'm okay with that as well, because again, I didn't lose money. So is the moment that the price goes to 1.5, I move my stop to break even. I let it run to 1 and 4. I take off 80 to 90% of that trade and I let it run. Okay. So now this trade here is running. It obviously came back and stopped me out. That's fine. I made like 3.5 R on that trade. That's a good trade. But again, remember, we're in an order block. So I'm still sitting here waiting for price to give me more opportunities to take a trade potentially, right? So if you're starting to look at stuff here, you might be looking at these legs, right? And maybe you took a loss here because price did break this structure, came up, retested this. Maybe you took this loss. Potentially you took this loss. But again, you're only risking 0.25% of your trade. So you're now, even though you won this trade, you made 3 R. you're down only at 25% of 1R. So you're actually still up 2R, even though you've taken 2 losses, right? And then you're waiting for price to do the same kind of thing. So if price starts to come into here, right, and you start to look at the break of structure, well, you have your 2 candle pullback, you have a break of structure trade. So if you wanted to take that trade, you put your stop here. Again, because of spread, I'm giving myself 2 pip. So there's a 2.7 pip. So if the actual trade, this was a 1.7 pip stop loss, you're putting it above the spread. So realistically, you're probably still in this trade. And at this point, you know, I'm doing the same thing. 1.5R, I'm putting my stop to break even. So around here, this trade ended up hitting 3R, actually more than that, right? Because it never even stopped you out, right? So now this trade's at 5R, right? So now you're out of that trade. And now, even though you took 2 or 3 losses, you're actually up now 5 or 6R. And then again, because you're in an order block, you're still waiting for price to break structure again. And then again here, you had a break of structure, you had a swing high, break of structure, there's trades. And this is basically all I do. I look for these breaks of structures near the zones or the alerts that Ann sends out, or I create my own based on my own charts, right? And then I just start taking these trades. And again, the key, guys, to this is risk management, right? Risk management is really, really important. So with all that being said, I'm going to quickly break down one trade that I did take today so you guys can see that this is not all hindsight. Obviously, looking back in the past, anyone can be a winner. But let's just quickly go to today. I'll show you what I did for my trade. And then I'll probably open it up for questions because there's a ton more we could talk about. But obviously, there's a limited amount of time. I do want to respect people's time and have questions asked if need be. So this is the zone here. Okay. So this is how I ended up sniping this entry this morning. Okay. I talk about this a bit in my videos, but this is a bit more of a complex strategy, which is called a fair value gap or an imbalance or leftover orders, etc. That I look for. Okay. So I saw that. Okay, and I have an indicator. It's called KZ boxes, guys. As I mentioned to some people in the group, a lot of my trading is influenced by ICT, and he talks about the kill zones. I do typically trade the London and New York sessions, and I will look for trades inside or around these green or yellow boxes because, as you can see here, these impulse moves in the London inside of these zones is very, very good. And typically what ends up happening, you will find, please go and back test this for yourself, is that when price starts to reject off the London close here, this typically creates the low of the day. And so there's trade opportunities to go higher. As you can see here, the price in the New York session never broke the London low. So this is what I typically look for when I wake up. I'll see what the London session did, and I'll look to take a trade typically in the opposite direction of what London did. So here we go. This is what I did this morning. So I woke up. I was not awake, obviously, at 3:30 in the morning, but price was doing this. It was breaking structure. These are certain trades that you guys can take. If you're looking for Confluence and break of structure trades, again, there's multiple order blocks that were creating block flow here as price broke this swing high. But I was looking for, I woke up around, what was it? It was about 7 o'clock. I woke up. So around here. And I noticed that we created multiple touches, okay? I don't look at those as trade opportunities. I know that some people do. That's the retail trader mindset of support and resistance. That's fine if that's how you trade. I look at this as liquidity. I look at is that the bank does not want to trade retail mindset. The bank wants to take the orders lower. It wants to mitigate those orders so it actually can take people out of the market to then give itself the ability to go higher or in the direction that it wants to go. So I drew this zone, and you guys can go back in the chat and look. This was all drawn out prior to me taking this trade. I did post this. You have liquidity here. You had an impulse to the high that broke this. When price started massively selling off, this is what got me really interested in this trade. I started instantly looking for the imbalance that price in the London session did not fill. And this might seem crazy to some people, but I drew this fair value gap region by simply going down to the left and looking at after the London move that created the low of the day, what was left over. And as you can see here, this imbalance that broke this structure only wicked down to here. It did not retest this order block up here. So I then knew that there was mitigated orders that have to be taken out here. Okay, or sorry, left unmitigated orders that had to be taken out here. And so I drew my fair value gap zone here. This is a strong low because it created the impulse and you have imbalance here. So I decided to take a trade, and I shared it in the group exactly like this, where I took a long position and I put my stop slightly below my fair value gap, and I took this all the way up here, right? So as you can see, that trade worked out. I did not hold it. It's still moving higher. I did not hold it, but that is how I played this out, where I do not care about all what's happening here. I don't care about losing out on this order. I look at what price is trying to tell me from a non-retail perspective, from a, when everyone talks about on the internet, buy low, sell high, or buy high, sell low. Well, why would I want to buy up here? Why would I want to buy up here when there's leftover orders that are here and price is moving really impulsively into that, right? So that is simply what I did. I looked for the break of structures. I had my Confluence. There's a bit more stuff to these trades that you can look into for yourselves in terms of institutional trading, 𝐦𝐸𝐿, etc. But this was the trade breakdown that I took. And I ended up sniping this. Obviously, I could have sniped this even more. But again, I tried to cover for spread just in case. So this trade ended up working really nicely. And I got my RR for the day off one trade by just being patient and not trading in all of this garbage here. So with that being said, I know I went a little bit quickly. Obviously, guys, you guys can watch the replay over and over and over. But just to quickly recap, when you see these order blocks, right, when you see these 1 hour, 2 hour, 3 hour order blocks take form, actually, let me do one last quick thing if people have another 5 minutes. There was a gentleman, Armin, who asked for feedback on a trade he took or was looking at on 𝐂𝐤/JPY, and I broke this down. And this kind of also proves, guys, the fair value gap region. And this is, honestly, if you guys practice this, this is how you can get really crazy R value trades, okay? So let me quickly do one last breakdown, then I'll open it up for questions quickly. So I was presented with a question saying, okay, now it was on the 30-minute chart. Now on his MetaTrader 4, this doji candle here was actually red, so it looked like it was a down candle. On TradingView, it's not a down candle, but it doesn't really matter. On his chart, he thought this was the order block. In theory, that's a valid order block, right? But I mean, I would hope that people are not trading like that massive of a stop loss, because you're not going to get any R on that. So I said to him, well, if you look at what London session did, right, it created the low of the day on that day, and it did not fill these orders, right? So London moved impulsively away, and there's a fair value gap here. So you could have actually been looking for a trade inside of the fair value gap instead of taking that whole order block, and instantly you actually get a better R, right? Like instantly there's a 1 to 4. Sorry, FX, yes, I did send some charts in Anne's group, yes. So you get a 1 to 4, right? Versus like you would have not have got that because your stop loss bid would have been way up here and you're already only at a 1 to 5, right? So if you're talking about scaling into your trades, look for where price left from really, really rapidly and didn't fill orders. But I said to him also, what you can actually do is if you want to scale into the 1 minute, there are leftover unmitigated orders, and there is a 1 minute order block here that got touched. And as you can see, it perfectly touched the 1 minute order block, and this would have netted you a 1 to 42 R trade at the moment, okay? And I'll show you how you can find that. You simply draw out your fair value gap on the 30-minute chart that you're looking for. You then simply scale into the 1 minute chart, and you go to the left and you find the order block that was inside the fair value gap of that day, okay, that created the massive impulse. Whoop. Sorry, guys. I dragged the side of the window. Okay, so here you go. Okay, we are inside the fair value gap. We're inside the London session that created the low. And what is the last order block that created the break of structure? Well, it's this tiny little order block. And if you would have been patient enough to look into that, research this, find this order block, Well, you go back to your 30-minute chart and you just sniped a beautiful 1 to 40R trade. Because again, guys, remember the institutions, and I know it sounds funny when people talk about institutional trading, there's no one on the internet that's going to tell you exactly when to take a trade. But with these concepts in mind, you can get very, very close. And as you can see here, this one, in my opinion, would have actually been a perfect trade. I don't know how you get any better than that. The institutions wanted to mitigate that order that was not filled inside of the fair value gap, and you would have sniped this for a very nice trade today. Okay, so this is where we're talking about in terms of scaling into the trade. So with all that being said, please rewatch this. I will answer questions now if there are questions from people. So either type it in the chat or I think I can let people unmute themselves, but I'd like it to be one at a time if possible. Tim Thomas, you're setting pending orders. So I will, depending on how big of the impulse is away from my 1 minute candlestick. So for instance, if like in some of the trades we broke down, let's just go to the 1 minute and I'll just like, we'll just make up an example here. Like for instance, let's say.
Is that a read?
Someone unmuted themselves. Sorry, can you just mute quickly? Let's say that I was waiting for like this 1 minute impulse move to the downside. In this case, yes, Tim, I would set a pending order. That is not always the case. Sometimes, you know what I mean? You get like an impulse down to the downside. You get 3 minutes and it's up to your candlestick. What I'll do is I actually use Ann's EA system because I like that it calculates all of my pip sizes, my lot sizes, all that stuff for me. So all I do is I actually hit a send now order button and then I drag it to the top of my order block and then I hit execute order. So that would be a market execution, but I like it because I have my settings all set to properly risk based on what I want to risk. And then I don't have to worry about creating lot sizes and figuring all that out because I'm on the 1 minute chart. So that's what I personally do. Okay, sorry. Do you have another example? I can definitely try and find one for you, FX, and I can share that in the group. I probably don't have exact time to look at that, but if you actually start going through the chart, guys, and looking for unmitigated orders on order blocks, you can see this very clearly here. So for instance, here you have a downtrend, you have an up candle impulse. This is your order block, right? If you actually look at where, like why price is doing that, because you have unfulfilled orders. This happens all throughout the charts. That's why wicks are created. So if you actually like put this in replay mode and you were sitting here on your charts and maybe you wanted to take a continuation trade because you see price making higher highs, you simply just need to like draw out the zone of unmitigated orders, right? So we have this that didn't create a wick, this only wick to here, and then we had this wick. So you'd be waiting for price to mitigate all those orders. And once it mitigates all those orders, that could have been your entry zone, right? So you could have put your stop loss. You could have taken a long position and I would have put it right actually at the top of that order block. If you want to be safe, you put it at the bottom of that order block and then you target the next swing high. Now, I don't believe this one ever went to the swing high. However, you still ended up.
What should it be?
You still ended up taking a 1 to 3 restored trade. So that's just a quick example. But if you guys go back in time and you look at, or I can, I'm going to mute everybody.
I can read here.
Sorry, Sue, can you mute? I can't seem to mute you. I will answer questions probably in the chat. I think it's easier. Thank you. So that's an example, FX, of like looking back in the past on why wicks are created. Wicks are created because it's actually mitigating orders because you can't have impulses straight up. The market never moves straight up. It creates waves. And if you start to notice that there's unmitigated orders like this, these are potential trade opportunities as price gets lower. And I can explain that a bit more on another call. So I'm just trying to answer a few other questions here. Question, what is a KZ box? If you want to look into what KZ boxes are, that is the indicator I use. It's called an ICT kill zone. Okay, it's an institutional trade. It's a scheme that he uses that basically, based on his research, he has found that the biggest impulses happen during those times. So there is an indicator on TradingView that you can find called ICT kill zone boxes. Feel free to try that out. What it will do is it will create these zones. And if you go back and back test, typically you'll find that these dots at the top are the high of the day and the low of the day, that the Asian session or the London session will create the low of the day. So when that's the case, I will then know that price probably is not going lower than that, and I'll look to trades to go higher, right? As you can see here, the low of the day was actually created in the New York session, so I'd be looking for trades to go higher. And as you can see here again, this is your low Asian session. London didn't go lower than it, so I'd be looking for trades to go higher into London order blocks, and there would have been a few here. So that's also how I personally look for trades every morning. I have these indicators on my charts. I understand that the low of the day typically is created by the London session, so I'm looking for trades to the upside or in the opposite direction, okay? What group did you share in? Oh, sorry, Paul. I don't know. This video will be shared, but I have traded or shared private videos to people. I did have a chat message in the group that basically said, hey, if anyone's interested, this was yesterday, is interested how I take my trades, because I took a US 30 trade that was quite profitable and people were curious. So I did record a video on the breakdown of that, and I privately shared it to people. Please DM me. I'm happy to share that with you as well. It's very similar to what I just went through today, though. Session indicator. Yeah. That's the KZ boxes, and I use the Asian range by 𝐂𝐤𝐿 948. That is what these gray area is. I personally believe that the Asian session sets up for the liquidity grab of the banks. So I like to see what the Asian session does prior to me waking up in the morning for my New York push. Do you have any videos on the fair value gap? No, I can definitely create some more videos for people on fair value gaps. When you say during London session, price cannot break London low, is this true to the opposite? Yes, absolutely. But guys, you have to remember, it's not 100% guaranteed. But if you go back and back test these, you'll see in a lot of cases that London made a high and the New York session ended up trading the order blocks down to the downside. Now, after New York KZ box, yes, it made an impulse up to the high. But there's plenty, again, we're on the 30-minute chart. There's tons of trades for me to take, knowing that the high of that time frame was London, so I can trade in the opposite direction of London's high, right? And again, you can see this very clearly. London made a low. I would then be trading impulses to the upside off New York, right? And again, London made the high. I would be trading impulses to the downside off New York. It's very simple. This is what I do every single day. I wake up, New York session, and I trade in the opposite direction, typically of what London did. Okay. I think the point is finding the zone. Yeah. Complete go over how to refine the OB zone on the 5-minute chart. Okay. I'll do a quick one. Again, guys, I mentioned in the beginning of this call, refining the OB zone on the 4-hour is the exact same as refining the OB on the 1-minute or the 5-minute. It doesn't really matter. You are simply just waiting for price to come into that zone. The only reason I go down to the 1 minute is because I think there's more data there that I'm allowed to trade. So here's an example here. So you have the high of the day created by the New York session. You have an impulse to the low. This is for you, Rose. I think this was your question. So I would be looking at a trade. You have a 1 candle pullback. You have a 2 candle pullback, and then you have a break of structure. So here's your break of structure. I understand I'm going fast. Sorry about that. You can watch this as many times as you want. This is your OB on the 5-minute, okay? This is your OB on the 5-minute. I would be putting my order block zone here. Whoop. There you go. There's your order block zone. And there's your trade opportunity. Now, if you would have waited for next day's London session, that would have been an absolute monster of a trade. But if you weren't, you could then go on the short position here, and you could just do this. And again, that's a 1 to 5. But let's say you didn't want to do that, and you actually wanted to then scale in on the 5-minute order block. You could probably have done that. Now, I don't exactly know. Again, this is price of, where do we got to go here? Here we go. So again, this same 5-minute order block, right? It created the same kind of market structure, right? You look at what block flow is being created, guys. So did this create a new low? It didn't create a new low. You have a 2K. So this is where it gets a little interesting. You have to back test for yourself. I would say on the 1 minute, this is not a very clear entry. You didn't really have break of structure other than the fact that you were creating order block flow here, right? So you had a one candle pullback, and this is what I call a drop-based drop, a drop-based drop. These are really interesting trade opportunities when you look at what price is going to do. But I would say personally in this, if you were to scale in that 5-minute trade, there's not a really good entry. So that 5-minute trade would have been good. However, there are other trades that you could have been taking inside of these zones as price starts to create new block flow, right? So you have to remember, if you believe the market is bearish, it creates another drop-based drop here that created a new low. So you could take these trades, right? So this would have been your order block, and then you just keep taking trades as the direction moves down. And this is what's called block flow. If you go back and back test, you will start to see that as price is moving lower, it's creating micro order blocks that you can trade from to snipe entries from, okay? I'm going to move on to another question. So is FVG better for that instead of an order block? So here's the thing, guys. When I'm talking about a fair value gap, I like to use fair value gaps as confluence inside of order blocks. This is why, if you go back and back test, why sometimes an order block will go to the 50% level. Sometimes the order block will go just to the wick. Sometimes an order block will go to the very top. It's because there's unmitigated orders by the banks. So if you start to look at where price is unmitigated, and again, the way that the Forex market moves, you're always going to have leftover price. That's just the nature of it. These potentially are trade opportunities in the future when price comes back into this, knowing that that's unmitigated order. But you can start to then understand, like, why did price come into the middle of this order block? And typically what people find, and again, you can see that this order came perfectly into the middle of the order block, but there's leftover orders. Right? So if you go back in time and you're just simply following the wicks and you look at, like, okay, so I have an order block that was created here. There's a wick here. So see that wick, right? Price wicked into it and then came down. Well, there's leftover price there. So what I'd be looking for is price going to mitigate that order, and it did, right? So it came up, it mitigated the leftover price, and then it just continued tanking. This is why the wicks are formed. They are telling you something. It's helping you. It's not spiking you out of trades. It's actually should be helping you find leftover price that you guys can actually snipe from. And this, again, this all happens exactly the same on the 4-hour, guys. That's why there's 4-hour wicks, because see how this impulse on this candle was created? Well, price had to mitigate those orders, and then it continues higher. So just keep that in mind when you start seeing wicks form. I don't have any YouTube videos. People have asked me. It's something I've thought about making. I don't. Ann talks about all this kind of stuff. I just go to it from another perspective. So if you talk about, if you start to understand how to get into these orders from Ann's alerts, I think you guys' win rate will go a lot higher when you wait for price to mitigate certain things. And if you aren't clear on how to wait for that, honestly, using the 50% entry that she talks about is a really good confluence. Another good indicator shows highlights. Okay, so someone else mentioned FX market sessions. That's awesome. Thanks, D. Williams. What time are you looking for? What time? Make sure you look at charts for New York session. So I look at New York session when it opens, ideally at 5 a.m. Sometimes I'll get up at 6 a.m. and then I'll look for trades, because there's always going to be order blocks, guys. Like if the price is already going higher, there's an order block that will be created again to keep it going higher if it's going to go higher. Can you please go back to the FVG again? I hope I just talked about that, Ben. I think so. If not, guys, please, if there's other questions, I can definitely create more videos. I'll talk to Anna. We can maybe do this again. Absolutely. I'd love to. What is your setting for KZ boxes? It's, well, actually, let me double check. I think it's default, but because I'm in PST, guys, so I have my KZ boxes set to 2 and 5 and 7 and 9, because the 𝐂𝐡𝐞𝐤 boxes, guys, are generated by New York time, okay? So if you change your charts over to New York time, you can. However, I reset mine because I'm UTC, okay? UTC 7 Vancouver. And again, yes, like Christopher said, wicks must be filled at some point. Absolutely. Can you do a quick top-down analysis to the 1 minute so we can see the whole process in action? Hey, Chris, you might have joined late. I did do the whole process. Please rewatch this video. We've been already on for 45 minutes, so this will be posted afterwards. Any other questions? Thank you, guys. Appreciate it. Okay, it looks like we don't have any other questions, guys. Please watch this video as many times as you need, and I will definitely be in the group to answer any questions. Send charts. Can you explain manipulation around the OB as well? I think I did. So I'll just quickly 2 minutes here. I talked actually, and Abdul, I can send you a video. Yes, Fennel, this will be posted later. Absolutely. I did talk about, there's a video I send about manipulation around the order blocks. Again, guys, when you're talking about manipulation is simply, again, unfilled orders to mitigate fair value gaps and imbalances. So for instance, when you guys are looking at trades like this, okay, so here's a very quick example in 𝐂𝐤/JPY. I know it's in the past, so just keep that in mind. But if you guys go and back test this, it is literally how the markets move. So if you look at this order block up here, and this is why sometimes, guys, order blocks don't always fill, right? So this order block on 𝐂𝐤/JPY didn't get touched yet, but look at how price came in and then reversed. Well, it's because there was a fair value gap. So when you look at this imbalance, look at how price and the wicks filled right here, right? We have a wick that filled, a wick that filled. But where did price not fill? Price did not fill any of this zone. So if you look at this wick to wick, right? So let's zoom in. Wick to wick. Where did price fill and then tank? Right here. There's your trade. Massive trade. Because price just wants to fill the unmitigated orders. So go back and back test. You guys will see this happen all the time. Can you say what you said about wicks helping us? Yeah, so that's basically what I'm talking about right here, guys. Jim. So these wicks here, like if you would have waited for this this order block, obviously it probably would get mitigated. Yeah, so it did, right? So this order block did get mitigated at some point. But see how this wick went above it? It's because there was a fair value gap up here. Price moved away from this zone very, very quickly. So above the order block was your fair value gap. And as you can see, if you would have waited for the fair value gap to get filled, you would have not got stopped out of this trade. You could have waited for price to tell you it's going to go lower. And this is why I like fair value gaps in Confluence with order blocks, because you can actually help yourself not lose trades. Okay, cool. I think that wraps it up for at least for today. And guys, please, like I said, questions posted to the group. I'm here to help. So, yeah. FVG similar to imbalance, correct. Awesome. Thanks, guys. Appreciate it. I do not have YouTube videos. Hoping maybe one day I will. People keep telling me to do it, so I might do that. There's no indicators for fair value gaps. Your eyes are the best indicator, in my opinion. Just look for missing price in between wicks, as you can see here. Okay, guys. Keep asking questions in the group. I got to jump off, but thank you very much for attending. I really appreciate your time. Thank you, Anne, for letting me do this. That was awesome.